Profit before tax seeing a 31% increase, PAT up 16%, but we've had gross earnings sliding back, easing back 5% compared with the prior year. So the filtering through of that growth to the top line still proving to be a bit of a challenge here.
Yeah, certainly. I think that's right. You know, gross earnings don't take account of what's happened on the interest expense line in particular. And what's occurred in the market is that clearly there's been a reduction in interest rates in general. And while we have managed to grow our risk assets significantly over the period, close to 41%, the net impact of the lower margins has been seen around our interest income line. But in general, our revenues are up, which is pleasing year on year, and fee and commission in particular looking very strong for the year.
We've seen a decline in revenue from corporate and investment banking. How do you reconcile that with the fact that the bank has seen strong growth in its loan book and, as you mentioned, a 41% increase coming through there?
The main impact on that is that big part of our corporate investment bank is our global markets business, and there are two aspects to that. One is the trading revenue. If you look at what's happened on the foreign exchange markets, they've clearly been a lot more stable throughout the course of 2010, and you've seen about a 36% reduction in that trading revenue. The other impact is on fixed income, where again those markets, we've seen activities on there being relatively muted for the period of the year. But outside of those two businesses, CIB as a whole certainly had a positive year. We've seen the risk assets grow very nicely, and particularly in the advisory businesses had a strong year and some great mandates that they managed to close.
With that growth that we've seen in the loan book, attention immediately gets drawn to the management of that heightened risk position, and in that regard you've seen a corresponding 24% reduction in non-performing loans. How are you managing that position? What are some of the risk mitigating strategies you've got in play right now?
Well, I think you know, it's subject to the fact that we put in very extensive and we believe are very robust risk management processes across all of our businesses, and certainly as we've seen the significant growth coming out of our personal business banking side, which loan book has grown almost 100% year on year. You know, that takes a lot of systems and a lot of management in terms of ensuring that we understand the particular market. Much of that is secured in some form or other, but we've seen very good growth there. I think the other feature of our results is that, you know, the reduction in our non-performing loans is not due to significant sales to AMCON. We did participate in AMCON, but it was to a very insignificant level of 14 odd million. So this is all due to our own activities within our book.
Absolutely. I mean, your participation in AMCON loan purchase so far this year is relatively small. AMCON is expected to buy up more loans before the end of March, though. To what extent will Stanbic IBTC participate, and you know, what's the likely net effect on earnings for this year?
Well, the answers are probably going to be reasonably insignificant in terms of the net effect of the specific sale to AMCON. We've said a number of times, if you look at our current non-performing loan book, we've got a little bit of a concentration risk in CIB in particular, or one or two very significant loans. But as we've been saying, we're making very good progress on our own workouts on those particular loans, so we would think that we would actually be recovering some of that during the course of 2011 anyway. But we're actually, as we speak, in discussions with AMCON on the valuation of some of the securities to see whether commercially it makes any sense for us to do a transaction with them rather than obviously manage it through ourselves. But net result is likely to be not particularly significant in our case.
Chris, in the meantime, your 2010 cost-to-income ratio is relatively high, sitting at 70.8% compared to 65.3% for 2009. Explain why and what that 2011 target is in that regard.
Well, the reasons of why are twofold. One is that we are continuing to invest. As we've said in our results, we've made some really important and strong progress in the development of our infrastructure, particularly our branch network and our ATM network, which has now basically doubled since the time of the merger in 2007, and that comes at a price, and certainly those costs, you are seeing the impact in the growth in our cost line. Having said that, we're recognising as well that it's been a reasonably tough revenue generating environment, and we think in 2011 that's unlikely to change dramatically. Hopefully in the second half of the year it will pick up. But our sense is that while we are watching that cost income line carefully, we would think that for 2011 there will be a reduction, and hopefully around about between the 65 and 70% level will be something that we can achieve.
Well, your branch presence certainly impressive. 71 new branches having been opened in 2010. Update us on any plans for inorganic growth and the bank's possible interest in some of the rescued banks that are still sitting as potential targets.
I think between Standard Bank and ourselves, we've made it reasonably clear that I think they shouldn't expect us to be buying a bank at this point in time. I think we've clearly, for us, any inorganic growth is around building of scale, and for that it's about customers and branch network, frankly. And given what we've managed to achieve this year, I think our confidence in our organic capabilities to build a branch network and other channels to which to serve our customers has improved significantly, and we will continue to develop that. Having said that, clearly the challenge for us now is how do we grow the number of customers and the contribution they can make.